welcome to the Money Show, your one-stop destination for all your personal finance queries. I'm Kavita Thapniyal, and the show that we have lined up for you today is quite interesting because we're going to talk about common mistakes that investors usually do when they invest in mutual funds or via mutual funds in equity. And we will also answer your portfolio queries today. So just in case you have any queries related to your financial plan or your financial portfolio, you can send across your questions on our WhatsApp number, which is 865-797-4571. You can also email us your queries on themoneyshow@etnow.tv. So let's begin the show. And today we have Shweta, Rajani, Head Mutual Funds, Anand Rathi Wealth, to answer all of your queries and to help our viewers understand the common mistakes that they might be doing unknowingly or by default when investing in a mutual fund. So good evening and welcome to the show, Shweta. A very important topic, looking at the kind of SIP books that we have every month, which is reaching a new high. By default, we are just following a trend in a lot of ways, and there are a lot of young investors who need hand-holding and a guideline to invest in mutual funds. So let's just talk about people committing common mistakes when investing in mutual funds, or when they are just generally trying to become an investor and having that not having the discipline to invest right can impact their entire financial future. So which are the common mistakes that you can just highlight, top of your mind, what's coming on?
Sure, Kavita. Good evening. So, I'm just going to bucket this like you did and first talk about the common mistakes people make when they are either starting their financial journey or, still in the early phases. The first and the most common mistake that they do is not setting an objective. Because if you don't know what is your destination, clearly that financial journey may not go the right path. So that's, one common mistake. Another common mistake is not having a proper budgeting in place, which helps you understand what should be your ratios of, investing to income, what should be your ratios of loan to income levels. That's another common mistake. Third one, not getting your asset allocation right. And I think, I'm just going to say the fourth one as well here is not reviewing your portfolio on a regular frequency to see, are you getting towards your objective or are you deviating from your objective? So this is something that comes on top of my mind as far as the overall, financial planning is concerned. And, coming to mutual fund investing specific, I think one mistake that people commonly make, whether you are a new investor or you are an experienced investor, is to fall prey to past returns. We tend to look at past returns of a fund and take our investment decisions, which should not be done. There is enough data that shows that a scheme which is done in past has only a 20 to 25% probability of doing well the next year too. But people, tend to fall prey to that. Second mistake is, what I would say as following the trend. So if we are seeing a lot of money going into, let's say, a small cap or going in a specific theme, we think that we are missing out and we should also have that in our portfolio without realizing whether this is really needed for our portfolio given our risk and return profile. That's a common mistake. Third one, I would say investing in NFOs, because we think just like a stock, an NFO is something that we are getting at early stages, or we're getting it at, the bottom 10 rupee NAV, so it's a good buy. But that may not be the right decision. So these are, 3-4 common mistakes, both at portfolio or mutual fund level.
So let's deep dive into more common mistakes that people generally do when investing in mutual funds. And one very common thing that I'm sure even you must have observed or noticed during the show, a lot of our viewers actually follow the advice that the expert give to someone else, and they take up the same kind of funds and start investing. This is a very show specific problem that I'm discussing with you, but generally also people just pick up the best performing funds in different categories and just follow the trend. So following the trend, how wrong it is, and how should you decide then what is good for you and what is not?
You're actually right, and I have seen this commonly happening, which you highlighted that you on the show. It happens that you've given a recommendation, but that recommendation is for that specific client because that specific client has a different goal. So you cannot just blindly pick that fund up for your portfolio as well. So it is very important. I think 3 4 points that I want to highlight. Anyone listening to any recommendation, first see whether your goal is same as the other person's goal. When I say, how do you check, is it a similar time horizon that you are talking about? Is it that you have the same asset mix as that person? Because that person may be talking about 50% of his portfolio, but you're considering it for 100% of your portfolio. Then that again is not a right decision. Third, what you should see is your goal flexible? Somebody else may have a goal which may say, I have a goal which I have to achieve 5 years down the line. But even if I extend it by 1 2 years, it's okay. It may be something like a house buying. But you may have a goal which is child's education after 5 years. Your goal is the date is inflexible. You will have to pay your tuition fee at the end of 5 years. You cannot extend it, by one more year. So it is very important that you compare what your goals are with somebody else who's got that recommendation. I would say if your goals are exactly matching that other person's, then you can take that recommendation. However, one more check before you do that is see what is your risk appetite. Someone may be willing to have 80% of their portfolio in equity because they understand that market and they are willing to take that much risk. You, on the other hand, may want to have a 60% equity on your portfolio. So, understanding your risk appetite becomes the second important point for you to check before you say, I can also invest in that same fund. Third, I would say, to also check that when you are taking this decision, what are your other investments that you have? So, I may give a recommendation to somebody else saying that you need to increase small cap, and I may have given a small cap recommendation to another client. But if you already have a 25% small cap in your portfolio, you cannot go on adding on to small cap in your portfolio, for example. See where does it fit in your overall scheme of things. So these are, Kavita, to my mind, 3 4 things that one should keep in mind when you listen to somebody else's recommendation and before you take your decision of investing in it.
Also, one common mistake, or maybe a problem with the mindset, or lack of awareness and knowledge, maybe investing in mutual funds like the way you do in stocks. You pick up funds like you pick up stocks, and then how you decide a time frame in a stock. Maybe usually it is very short term. The same kind of expectation and same kind of time horizon in a mutual fund. Where can they go wrong here?
So, when somebody is investing in stock, you could either be a trader, you could be an investor. But I would say if you're investing in a mutual fund, you are an investor. The difference is a trader may have a short-term time horizon. He's taking a short-term view on a stock. As an investor, you're looking more from a long-term perspective. So that's one key difference. If you're an investor, then you clearly have to look at mutual funds in a different light as compared to what a stock would be considered. Second, when you're investing in a particular stock, you've kind of you're doing your study on that particular sector. You've done your study on that stock. It is more company specific. So your decision to exit would be basis what the profitability is, what the next few quarters or years return potential is looking for that specific stock, and accordingly you're exiting or investing in it. But as far as a mutual fund is concerned, all this is done by an professionally run fund management team who at their level are constantly reviewing the portfolio and making changes to it. So you're not responsible, to take that sector or stock call. The fund manager is doing it and constantly improvising on the portfolio. So therefore, when you invest in a mutual fund, you should have a long-term view. Of course, you need to track it on a regular basis, but if something is not performing on, let's say, 1 quarter basis, also it doesn't mean that you must exit out of which you may do in a stock listening to the management commentary after the quarterly result. But that's not something you should do for a mutual fund. You should give it some time to perform, a reasonable time period for it, to deliver returns for you. and it's being already actively managed. So that's, I think, the key difference between a stock investing and a mutual fund investing, which an investor must understand.
A lot of trendy things happening, like investing in NFOs, investing in sector-specific funds or thematic funds. Where can one go wrong here?
So, you highlighted three things. I'll cover something on each of it. Investing in NFOs, to my mind, not necessarily the right thing to do unless it's offering something which is very unique, which is not available in the existing mutual fund schemes. But if there is an NFO which is coming in the mid cap space when you already have 25 other mid cap schemes available, it's always better to go in for a scheme which has a proven track record, a fund manager who's had a proven track record. And honestly, I don't see many NFOs which would be very unique. So NFO investing can be avoided. You may be getting it at an NAV, but it doesn't matter, even if you go in for a fund which is at a higher NAV, because it's a constantly changing basket. It's not like a stock which is trading at 52-week high, so you cannot buy it. Please don't follow that mindset. I do come across this, people saying, oh, but the NAV is 400 rupees. Should I buy? Yes, you can definitely buy, irrespective of what the NAV is. Investing in sector thematics, what happens is sector and themes are very timing specific. So if you understand that sector well, if you are tracking it closely, you are related to that, sector, this is the right time to exit, then sector or thematic funds are for you. Otherwise, go in for diversified funds because they're the fund managers doing this job. He knows when the cycle is turning around and when is the time to move out of A sector and enter into B sector. So most often than not, people lose money in a sector fund because they've not exited at the right time. So that's something I would say which is avoidable.
I think we have a lot to talk on this, Shweta, but then it's time for a quick break, and post that we also have our viewers waiting for their portfolio queries answered. So let's take a quick break, and we will continue the discussion on common mistakes that investors do while investing in mutual funds. But we will also connect with our viewers to answer their portfolio queries after this break. Welcome back. You're watching The Money Show, and let's get connected with our viewers. I have Shweta Rajani with me as our expert who will be doing life and financial planning for our viewers today. And Shweta, we are connected by Shashank from Bangalore. Shashank, good evening. How are you doing today? Thank you so much for sending across your question.
Hey, thanks for taking up the question. I'm doing good, thanks.
All right. So I understand you want to do a lump sum investment?
Yeah, I'm looking for lump sum investment. I couldn't invest in past few years because I was moving between the countries, and now I have sitting on a large corpus, and I'm a little bit worried about my investment.
All right. So the corpus that you want to invest is of 1 CR, and when you say long-term investment, this is 15 plus years we are talking about, right?
Yeah, absolutely. I'm looking for 15 plus years. If situation arises, I might withdraw a little bit of amount out of it, but yeah, I wanted to invest it for long.
Okay. I just want to understand these funds that you've mentioned. Are you already investing in them?
No, I'm not investing. I'm just doing research and finding out the funds. I have just jotted down few funds. I looked at the AUM and a little bit about the alpha, etc. And that's how I've selected the funds.
Okay, got it. So you've selected Nippon India Nifty 50 Index, Nippon India Large Cap, ICICI Pru Blue Chip, Motilal Oswal Nifty 500, Kotak Multi Cap, HDFC Flexi Cap, Motilal Oswal Nifty Mid Cap 150 Index, Axis Mid Cap, HDFC Small Cap, SBI Small Cap, HDFC Gold ETF. All right, so let's get connected now with Shweta, and she'll help you filter out the fund selection, although it's good. But Shweta, what's your recommendation? Also the allocation that he's decided for these funds.
Absolutely. Hi, Shashank. So, some things that I want to highlight for your portfolio. One is, see, at an overall portfolio level, given that you have a 20-year horizon, you can look at 80% equity, 20% debt on your portfolio. So just keep that, roughly in your mind. Now, I'm assuming this is the equity component of the portfolio. Most of your schemes that you've selected are good. I see some large cap biasness here, but I think to the extent of having 50-55% portfolio in large, the rest of it in mid small would be a good allocation to have. What you've chosen, where I think you need to relook, is index funds. To my mind, you don't need index funds in your portfolio. The two funds that you've selected, I'm just taking an example. You have a Nippon Large and you have a Nippon Nifty 50 fund, right? The Nippon Large Cap Fund has delivered 3-4% more over the last 5 years as compared to the index. So, which is where you don't need an index fund. So, the three index funds that you have, which is Nifty 50 index, Nifty 500 index, and the Mid Cap 150 index, I'll say no allocation required there. Instead, you can go in for an ICICI Pru Focus Equity Fund, go in for an SBI Large and Mid Cap Fund. That will take care of the large cap, allocation instead of being in the index. The other fund where I think within that category, Axis Mid Cap, you can let go of instead of Kotak Emerging is a better fund in terms of its consistency, the fund manager's capability, the AMC risk matrices, all of that. A third suggestion that I have is you've picked up an HDFC Gold ETF. Now, you did mention that you have a 12-year-old daughter. So I am assuming that you are investing in gold because you may have a future consumption when she gets married. If that is your need, then buy a sovereign gold bond fund instead of a gold ETF. If this is purely investing, then over a 20-year period, equity funds will give you a far higher returns than what gold can generally give. So if it's investing, then avoid gold. If it is for future consumption, then buy an sovereign gold fund. That's my recommendation. Otherwise, clearly, the other schemes you've chosen are good enough for your portfolio.
Is there anything else you want to ask, Shweta?
Yeah, I wanted to ask one more question. So, given the current market condition, it looks like it's down by 6% or so. I was leaning more towards getting into the multi-cap or the flexi-cap funds, given that I'm assuming that the fund managers might have already done their allocation rightly, and from this point onwards, flexi-cap can perform in short term. Definitely, it will perform better.
So, what I suggest is in your portfolio, you have a large, you have a flexi, you have a multi. The ones here that you're anyways doing is spread across different categories to give you the advantage of different fund manager styles. So don't be worried about the market level. Yes, it's been almost 7.5-8% down from the peak, but this is very normal correction in equity markets. We're looking at 20 years. This combination is good. Don't worry about that. You can just go ahead and invest in this portfolio.
Let's get connected with Mr. Debabrata Mohanty. Hi, good evening. How are you doing today?
Hi, good evening. I'm fine. How are you?
Doing good. Thank you so much. All right. So I understand you are investing in a few funds.
Yeah.
UTI.
So I'm investing in 4 funds right now,
Sure.
20,000.
Sure.
10,000 in index UTI Nifty 50 and 5,000 in Parag Parikh. I think
Right.
4,000 Parag Parikh and small cap.
Nippon India Small Cap, Parag Parikh
and,
Flexi Cap, DSP
yeah,
Nifty 50 Index. Okay, got it.
So in this market scenario, like almost 10% down from last 1 month, what should be my approach going forward? And can you please suggest me what needs to be changed or modified, or any foreign mutual fund should I have the exposure?
For how long you want to stay invested?
Like for 15 years minimum.
Minimum 15 years, and step up
Yeah.
you will do of 10% year on year. That is what you're saying.
Yes, correct.
Perfect. All right, looks like a good portfolio. Shweta, any changes?
Yes. Debabrata, you asked about what should you do in the current market situation. I think you're doing an SIP, which is a very good disciplined way of investing. And I'm also looking at a 15-year horizon. So don't be bothered about these market corrections. This is very normal market behavior. You're getting the advantage of averaging of the cost because you're doing an SIP. So do continue with your SIPs. Don't be bothered about the market level. Coming to your portfolio, you have a small cap flexi cap fund, which is a good allocation to have. Instead of what you've done is you've chosen 2 index funds for your large cap proxy. Just like I was explaining to the previous viewer as well, actively managed fund can give you slightly better return than a passive fund. And especially if I'm looking at a 15-year horizon, the compounding effect, even of a 2% higher return, will be way more. So stop your SIPs in the two index funds. Instead, what you can go in for an ICICI Pru Focus, go in for a Canara Robeco multi-cap fund. That will help you spread out a little more even in terms of your market cap.
All right. I think you're saying something you want to ask?
Yeah. So
Sure.
should I just fit in these two mutual funds or stop this and start a new like ICICI Prudential Blue Chip?
Right. Stop your SIP. Once it is out of exit load, then you can shift that lump sum also in the two new schemes that I told you.
Debabrata, and with that, it's time to sign off. Thank you so much for being on the show today, Shweta, and helping our viewers with their financial portfolio queries as well. Time up on the show, but then I'm going to leave our viewers with our WhatsApp number and email ID. Thank you so much for watching. Goodbye.
There comes a time when your heart calls for you to arise. Plant your feet solid into the ground. Decide your own limits. And then break right through them. Become something more. It's my time to rise.